Welcome, everyone, to the Capital Markets Wrap, sponsored by Polly. And wouldn't you know that today I actually wore a clean shirt, but for some reason my video isn't working. So, oh well. Welcome, Ira, James, and Rob. And should we just jump in, or any introductory comments anybody would like to make about anything at all? Nothing. Rob, where are you today?
I'm in Northern California.
Mill Valley?
I am.
James, you're in Maryland?
I am. I'm at my office today. We've got some nice winter weather, or it certainly feels like it. So yes, I'm here in Baltimore.
And Ira, you're just outside the Stone Pony.
Yeah, central New Jersey, we got our first snowflakes of the season, along with feeling the same effects of the weather as James.
Yeah. Well, there's never a loss of things to talk about, and I'm just going to jump in with the latest news, which is the consideration or the statement that uh, maybe 50-year or even 100-year mortgages are on the table. So I'm going to start with input from our most seasoned veteran, which would be Mr. Kessel. And Rob, have you seen this before? And why don't we have 40-year mortgages in the United States?
Um, I don't think I've seen, well, I don't remember seeing this before. Doesn't necessarily mean I've seen it before. Um, I would say that, first of all, it's interesting that US has a 30-year market. I'm just a huge fan of the US mortgage market with the efficiency we have with TBAs and the fact that we even have a 30-year fixed rate mortgage and what that does for housing. When not a lot of countries, very few have, a longer dated fixed mortgage. I think when you look at longer amortization periods than 30-year, you're not getting much reduction in payment. You're getting a lot more interest that you end up paying over the long haul. I promise Ira and James that at least, bring up one, counterpoint to it, what I think is the industry is at large disappointment or even irritation with this announcement. There was during the first Trump administration, there was a conversation about just 100-year US debt. It was that when rates were at historic lows. And, there's when you get into uh, climate modeling, there's this conversation around how do we allocate the right amount of money to the future, saving the future when our discount rates are so high. And that, if our discount rates are high, we value current benefits much greater than future benefits. And so there's this whole debate about what is a 100-year discount rate? What should it be? And so that, there's just, it's an interesting field. It's nerdy, but in that first Trump administration I think they were throwing out 1 or 2% on 100-year bonds. Just think about how nice that would be for where we're at right now from a debt point of view or interest debt service point of view. So I think there's, if you ask the 2.5%, or 3% mortgage holders right now, do they wish that they had a longer mortgage? Who knows? But anyway, there's just some other parts. I'll take one for the team and bring up some of the counterfactuals and hand it off to the pros.
I like
There you go, James. Any thoughts, James?
Yeah, I like it. I like it. That's I didn't. So before we were hopping on the call, Rob said he had a take and he would share with us. So there we go. That's an interesting perspective. I think I guess the thing that comes to mind as a starting point to that is, when you're talking about a long-lived, hopefully, sovereign nation, the time horizon, in my view, could be a little different than an individual. I think on this particular issue, I don't know about this one personally. I suppose there's an adage, perhaps that the Trump administration is using, which is that there's no bad ideas in brainstorming. But there has been 40-year mortgages before. They haven't really ever caught on. There's a few practical hurdles in the way that I see today, at least, which is, first and foremost, a 50-year mortgage would fall outside of the category of a qualified mortgage, making it a non-QM product. Now, that could certainly change. They could change the definition, but that would be a non-trivial thing from a regulatory point of view. Second, when we're thinking about the market structure, one of the biggest things is that we need a buyer. It's wonderful for the administration to suggest a new product, of course, but someone needs to be the takeout. Some entity or entities ultimately would need to buy billions of dollars of these loans. And if we snapped our fingers and solved the regulatory issue, I'm a little skeptical at what rate of return the investor community would require. What would that rate look like to the borrower? But then really for me, the kind of the third point I would make is, and Rob mentioned this initially too, is if you just compare an amortization schedule, let's just use a 6% 30-year fixed versus a 6% 50-year fixed, and just use a round number, let's call it a $500,000 loan. The monthly payment does drop. It drops by about $300 a month or thereabouts, maybe 370 if I did my math right. But it adds about $500,000 of interest. And we all know that not everyone holds loans in perpetuity, but I think the challenge in this one is that the borrower equity gets built much, much slower. So I could keep going, but my point here is certainly there are non-trivial challenges that would take some time to solve. So I'm very interested in any ideas that address home affordability, but I don't see it with this one personally.
All right. I think maybe the 57,000 people in Greenland have 50-year mortgages. But anyway, that aside, we'll leave Greenland off the table. Ira, are you hearing much from the origination staff in terms of, hey, when are you going to roll this product out?
Yeah, I think both Rob and James said it perfectly. There's a lot of hurdles, and we do see a lot of these tweets and messaging come out that are ideas, right? They're not necessarily hard and fast policies or products and things like that. And it's fine to brainstorm ideas, but one of the things in regards to the payment difference, that's assuming the rate is the same, right? And we know the rate will not be the same on the 30 and the 50 year. So once you sort of go through those models and try and figure out what the rate difference would be and the payment difference would be, it's not going to be too much of a difference. And we do already have 40-year non-QM loans available. We don't really see too much volume on them. They come up every once in a while. But it's really not too much of a popular product once we look at the rate difference and the availability there. And then again, the being in debt for life, right? 10 years down the line, how much equity you're actually going to have in the home is going to be a heck of a lot less, and that's assuming property values continue to increase. If we do see property values decrease ever, you could see a lot of borrowers upside down on their mortgage, once they realize how much principal has actually been paid off or the lack of principal that has been paid off.
Yeah, I would imagine that it's kind of one of those things where President Trump throws something against the wall and sees what sticks. Bill Pulte came out and said it'll be a game changer. And I think the industry participants kind of looked at each other and said, echoing the things that we talked about so far on this call, kind of like, there are other things we can do here. I did see an article, I don't know, a week or two ago, I think it was in the Wall Street Journal, maybe, where speaking about new products or different products, this isn't a new or different product, but they brought up adjustable rate mortgages. And the article, interestingly enough, was kind of anti-adjustable rate mortgage. Rob Kessel, did you happen to read that article, or James?
I did. It was, I think it started off, the headline was these evil products from the past are gaining, more popularity. And, I think we've talked about this in a couple couple of sessions ago, the Wall Street Journal said maybe it was 10% of production. I think James had pointed out at some point, maybe half that's agency, half of that's, portfolio product. I mean, as the yield curve, if we get into more of a recessionary picture with more easing, we'll have some steepening of the curve. There'll be some, some advantage, lower rates. That might make their way to affordability for, if in that kind of environment. So they've been around, they've come and they've gone. They're fun to deal with, both for hedging and for delivery. But if that yield curve cooperates, they're going to be, back in the mix.
I agree. Ira, do you do much in the way of adjustable rate mortgages, or do people shy away from them?
Yeah, it's been something that's come up a little more recently, probably because of the headlines, as you mentioned. We haven't really seen too much of that business come through the door. A couple here and there, more on the um, non-agency side. We did have we were looking at a couple of investors on the FHA side in regards to their FHA 5/1 arms, and we did see a little bit of a benefit on the lower end of the rate stack. The premium is still not there on those programs, but there was a fair difference in terms of the actual rate on the lower end of the stack on those 5/1 government arms. So maybe maybe in the future we'll see that pick up a little bit, but still not yet. Seems to be more of a bank product from what we're seeing.
Yeah, I remember uh, back after the financial meltdown, crisis, whatever you want to call it. It seemed like adjustable rate mortgages were almost like, oh my gosh, we can't, these are against the rules. They're against the regulations, and companies shied away from them. But the I don't think that the industry believes that adjustable rate mortgages are evil by any stretch of the imagination. And we've all seen how they can come into play and help borrowers. The issue, of course, is hedging, or a lack of a decent hedging vehicle. There is a company out there. I don't know if it's pronounced Iris or Eris, uh, which claims its product can hedge adjustables. It also claims its product can hedge non-QM, which is interesting. I've not looked at it, but who knows? Who knows? Necessity is the mother of invention. So if arms are making a comeback, maybe hedging isn't isn't far behind. The But it does, you brought up, portfolio, non-portfolio, and we talked about conventional conforming, and whether it's 80% or 90% or 95% of the production is still Fannie Freddie. Uh, I wanted to ask you, James, about the in recent weeks, uh, you know, people have taken a look at the loan level price adjustments that are being being charged, and thinking that we could or we should adjust those. Can you, for the benefit of folks on the call, explain why loan level price adjustments even exist?
Sure.
And might they, if, if changing them would have a material difference in affordability?
Yeah, absolutely. So yeah, maybe I'll start with why they exist. So in exchange for Fannie and Freddie to guarantee the loan, the GSEs charge lenders what's called a guarantee fee, which is some portion of the interest rate that's paid by the borrower. These days, headline G fees are somewhere a little north of about 50 basis points or so, just to kind of ground everything. But they also charge lenders what are called loan level pricing adjusters, or LLPAs, which account for the specific credit scenario in question. So in other words, a 640 FICO 90 LTV loan is going to have a higher LLPA than, say, a 760 75 LTV loan. So these LLPAs plus the G fee represent the total cost of guaranteeing that loan. Now, to your point, the recent news has been that FHFA is exploring taking a look at the existing LLPA matrix. They do that from time to time. And specifically, the initial proposal was that they were, or I guess the initial rumor, I suppose, was that they were going to be looking at some of the more punitive LLPAs for things like second homes and cash out refinances. Those types of products are a little bit riskier from a credit point of view. For example, the homeowner's more inclined to default on their second home than a primary residence. But that isn't a slam dunk. There were a couple voices, including the MBA, that suggested that LLPAs should be, if they are changed, they should prioritize purchase business and rate term refis. There's a methodological, if I got that word out right, debate here too, which is that LLPAs, some folks would argue that they should be purely based on the credit risk of the proposed transaction. And some folks would argue that LLPAs should be used to kind of help, quote unquote, cross-subsidize certain borrowers. So said a different way, there's a philosophical debate about whether Fannie and Freddie should be in the business of guaranteeing second homes and investment properties at all. But if they do, that perhaps they would be well served to charge a little extra and use some of that extra margin to promote primary residences and so on. Others say, no, LLPAs should just purely reflect the risk of the transaction in question, nothing more, nothing less. So certainly good perspectives on both sides, but I guess the other thing that I would add is against all of this, we still have the overhang of a potential GSE IPO as well, if the GSEs go public, right? So the question would be, are they going to kind of fundamentally change or at least materially change the business model while they're trying to go public as well? So I know that was a lot, but that's kind of the state of the world, I think, at least.
No. Hey, Ira, do you ever have originators say, well, why are we charging half a point for this where, ABC up the street is only charging a quarter point for this?
Yeah, so I mean, we always reference the grids, right? So when a loan officer goes through their pricing, goes to lock a loan, they do see all the pricing adjustments. Once in a while, there will be an extra adjustment from an investor. It's an investor-specific add-on for whatever internal reasons. Maybe something simple as a buy down, and they take a little bit extra because there's a little bit more work on the servicing side of things. But generally, I think you know, sales are pretty used to the adjustments these days, and even though they may not like them, um, they're used to seeing them. They're used to the numbers. One other point to add is, um, we look at the profits that both Fannie and Freddie have collected. These LLPAs definitely don't hurt those profits, and so it's sort of an interesting dynamic between taking Fannie and Freddie, quote unquote, public IPO, however you want to phrase it. Hey, good to see you, Rob. Or nice shirt, by the way, clean shirt. And so
Fresh
there's
in
that
London.
dynamic between, taking them public, the IPO, or continuing to take those profits in. And as we know, Fannie and Freddie are very profitable, and sort of losing that cash cow. I don't know how that would look to a lot of people as well.
Well, I'll tell you guys an anecdote. So I remember many years ago when AmeriHome was just getting started. Oh, did I mention AmeriHome? Sorry. But let's say a large correspondent investor was just getting started and they had no fee for non-owner occupied. And as I recall, Wells Fargo correspondent had a half a point hit for non-owner. Maybe it was a condo, whatever it was. Let's just say non-owner occupied. And I was talking to the person who set prices at Wells Fargo, kind of a mucky muck. And I asked this person, how do you charge a half point. AmeriHome is out there charging 0. Tell me about that. How does that work? Is it a long-term thing or what's going on here? And they replied that at that point, like Wells Fargo had, $1 trillion, $2 trillion, whatever trillion in servicing Wells Fargo had. And Wells Fargo had seen those kind of losses suffered on that product. And so instituted that half point hit for, say, non-owner. AmeriHome, which at that time had 0 servicing, didn't have that historical perspective. And so they didn't apparently feel the need to charge a half a point because they hadn't seen those losses. Well, inevitably, we all know what happens. the market is very efficient when it comes to seeking things out like that. And so I believe that AmeriHome was, swamped with non-owner occupied product and quickly went to market loan level price adjustments for that kind of thing. So the, you have that financial construct like, oh, okay, the actual performance of these loans warrants a half point hit. But you also have the social implications of shifting a lending population based on politics, based on social needs, whatever it might be. And so you can use Fannie Mae or Freddie Mac to guide the industry toward or away from a particular loan that whoever it is doesn't want to make. So you've got the financial side of things, you've got the political or the social side of things. So yeah, loan level price adjustments are obviously there for a reason. I don't think anybody does them for their health. But the question is, if they change, if they scale them back, why and by how much, and what implication does that have for the rest of the industry, FHA, VA, non-agency products? Where does the product flow? And as I said, originators and brokers, as we all know on this call, are very efficient at finding, an investor or buyer of loans that doesn't have whatever's going on out there. So along those lines, I wanted to ask Rob Kessel, uh, when you are hedging a pipeline, can you hedge against changes in loan level price adjustments, or can you hedge against credit risk or credit changes in credit policy? I know this is a little bit of an abstract question from out of left field, but it does come up once in a while, uh, especially what it was a year or two ago when it seemed like the agencies is like, oh, tomorrow we're going to change our G fee or whatever it might be. So, Rob, I wanted to ask you about hedging changes in loan level price adjustments and also credit.
Yeah, and generally, not really. They're not terribly easy or even possible to hedge against. I mean, I think one of the, getting back to the LLPAs, one type of LLPA is the servicing level price adjustment, right? Because like Fannie and Freddie have different credit characteristics that they're going to use to judge their risk of potential future principal loss. The servicers are also trying to make sure that they're guiding or protecting themselves against delinquencies or foreclosures, and especially given the state, depending upon what kind of foreclosure state it is. And so that ends up being a variety of different loan level price adjustments to protect the servicing asset. Now, if you're really going to get nerdy, you could say that the cash flows associated with servicing value related to these loan characteristics provide a different duration profile and would provide a different measure or metric as far as how much you hedge. So that's stretching to say that maybe for some of these changes in LLPAs related to servicing, if you model them correctly, you might be able to hedge for a little bit of that risk. With credit, though, I think that the stretch there would be credit default swaps or something like that, which is just this huge macro thing that I wouldn't really relate to a pipeline. But I'll see what the other folks want to say about that.
Yeah, James, any thoughts? That was a thorough, very good answer, Rob.
That
It'd be
was
tough to
a
follow.
very good answer. Yeah. I think the topic that really we're circling around here is kind of the fundamental credit risk associated with the transaction in question. And to Rob Kessel's point, both from a loan side as well as a servicing side and the cash flows associated with it versus kind of the business perspective and what you are trying to do from a business point of view, from an origination point of view, what additional protections you need to overlay on top of that, or what you're trying to do to be strategic. I think as we talk about changing LLPAs, one thing that does come to mind as well is how does that change the refinance incentive of potential borrowers too? That if a borrower was originated, their initial loan, that is, was originated under LLPA matrix A, And then now LLPA matrix B is in existence, for example, to what extent did the rate term refinance LLPAs change? To what extent did cash out refinance LLPAs change, and so on? And what does that do to a lender's potential for recapture in their portfolio too? So it's all holistic. It's a little bit challenging sometimes because it is because these LLPAs are administered by a third party, of course, and they can be pure credit or they can be pure policy or some mix of the two. But it ultimately impacts a lot of different facets of a lender's origination business.
Yeah, you bring up a great point, and that is when you originate a loan or when you purchase a loan or put it in your portfolio or purchase a pool of loans, you do that under a certain price structure, which includes G fees and LLP, loan level price adjustments. And if those loan level price adjustments change, obviously you didn't know that about that change when you were buying those loans. And so if suddenly I'm making these numbers, pulling me out of the air, but let's say the hit for a non-owner occupied loan was a point, and suddenly the loan level price adjustments change so that it goes to a half a point or a quarter of a point. Well, the refinance possibilities for those borrowers goes way up. And if you bought that pool of loans, thinking it would always be a point, and now it's only a quarter of a point, suddenly you've got high prepayments. So that that changes that. And the same on the credit on the credit scale, credit hits for credit scores and so forth. And Ira, I wanted to ask you, credit, everybody talks about credit changes and so forth, and TransUnion and Experian, Fair Isaac, et cetera, et cetera, et cetera, and a lot of talk, and then not much happens. And stay tuned. Well, something might happen in 2026 and so forth. Vantage score, yada yada yada. I don't know if anybody has really a great handle on exactly what is going on there, but Fannie Mae has been in the news recently since our last show, I believe, about the removal of a minimum FICO score. Can you bring the audience up to speed in terms of what's going on there and the implications and what you're seeing in terms of originators?
Yeah, so this was announced on November 5th. So they said that the minimum credit score requirements will no longer apply to loans submitted to DU. So previously, Fannie Mae DU required a minimum score of 620. If you had multiple borrowers, they did allow for one borrower to be under 620, as long as the average median score of the two borrowers were above 620. But now with no minimum score requirement, they're basically saying that DU will still sort of analyze the overall loan for risk, but you don't really have to quote unquote worry about a specific minimum FICO score. Now the pricing adjustments we just mentioned, the LLPAs, for a while now they have had um, an under 640 FICO score. So you could price those now. You could price those for quite a while now. So in terms of the credit risk piece of it, it remains to be seen if there will be an additional adjustment on the LLPA grade for an under 620 score. But it really, it's something that remains to be seen. Will we start to see borrowers move from, borrowers who maybe were in the FHA tranche, moving over to the conventional Fannie Mae tranche now, with there not being a minimum FICO score. We don't know the impact of the mortgage insurance pricing. So there's still a lot of factors to be seen on how this is actually going to play out. I don't really see it as a major mover, but obviously, any progress, if they're still going to evaluate the overall risk of the loan, realistically, a 619 versus 621 borrower, for all intents and purposes, what is the true difference between those two borrowers? So I don't see a real major impact, but it is a welcome change, and we'll see if it impacts any originations. Hopefully, it will.
Yeah, it seems like we're kind of nipping around the outskirts of change,
Mhm.
which, might be all that we can do at this point. I don't know. Once again, I should put a comment in here. Thank you to Polly for sponsoring this show, the Capital Markets Wrap, which we do on uh, the second Tuesday of every month. And it's obviously my favorite session, given my background as well as those on the panel. And I wanted to ask the silverback of the group, Mr. Kessel. Uh, you've been around through a business cycle or two, and the uh, we've got the news right now. We're in the middle of a shutdown. I shouldn't say the middle of. We are supposedly coming out of it. The Senate has voted to approve whatever it is, to approve to kick the can down the road. But I'll put my cynicism aside. So now it's up to the House and see if they want to approve kicking the can down to January, although there are some tweaks there. And you've been through shutdowns before. For the folks on the call tuning in here, what can we expect in terms of this sudden, is it going to be a sudden tidal wave of economic releases? Are they going to try to dribble them out? And what impact might those have on the market?
Well, it's I'm trying to think back about how if we've had this exact kind of thing before, because the no reporting of or the redoing of some of the releases and the non-reporting, and then the attempt to reduce confidence in the veracity of some of the numbers, has been kind of a campaign. And I'd say it's not just the administration, right? I think a lot of analysts have been kind of beaten up on things like the non-farm payroll numbers, the adjustments to the numbers, even like the components of CPI. Those are ongoing debates about the composition and the how good those measures are with what level of participation. So, we're going to have, and I don't know what the release schedule is going to be or the catch up is going to be. Um, and but to the extent it's going to come down obviously to what it's saying, and it's probably going to be an initial outsized first impact event, because if a lot of information is released and it's contrary to expectations, it's far enough outside of expectations that people think they got it wrong, then we'll have a pretty volatile market and a bigger response to that. It's certainly, I think everyone's confused as to which way it's going to go, on whether it's going to be inflationary or from a jobs position, positive or negative. But yeah, so no crystal ball, but just probably just more volatility as it rolls out.
James, do you have originators or anybody asking you, gosh, I just cleared this loan, just cleared underwriting, we're approved. Should I lock now or wait a couple weeks until the shutdown ends and we start getting economic news? Are you having those kind of discussions?
My originators know me well, and they know that I always say lock now, which is makes me very boring, but very predictable. Yeah, I mean, I think that's part of it. When we talk about the recent cadence of Fed rate cuts, for example, I think it's the last 5 times that the Fed has cut rates, that rates have ended up higher the week after or thereabouts. Which is always a fun conversation to have. So I think, again, to Rob's point, very, very few in the way of crystal balls. But I do think as we talk about the transition from away from the government shutdown into whatever is next steps, and Rob mentioned this just kind of briefly, but when we talk about the economic reports, one thing that I would emphasize is a lot of the underlying assumptions are worth noting. Like, yeah, the last 2 annual revisions to non-farm payroll have been nearly 1 million jobs each. And it turns out that the survey rate there has decreased significantly in recent years. I'm not suggesting it's an easy job, but certainly that remains one of the most significant events from a trading perspective every month. With respect to inflation, the monthly CPI report is a compilation of a basket of inputs, things like grocery prices and so on, but but also things like housing prices. And I'll spare everyone the deep dive into what owner's equivalent rent is. But suffice it to say, it's just one methodology out of many, and it's used in the U.S. to calculate the monthly cost of housing prices and inputs. But it's used in the U.S. Inflation figures, not in European, right? So my point here is simply that inputs matter. Understanding the inputs matter, and sometimes when we have disruptions like this to the usual, kind of cadence of the flow of information, sometimes we have unforeseen circumstances or unforeseen changes, and maybe the state of technological change or the state by which investors will adopt use of alternate data sources starts to change a little bit too. Now, again, large and sophisticated investors certainly have plenty of different sources and economic indicators and so on, but it's a good reminder for all of us not to be complacent and to be open-minded, certainly about new inputs. So what's coming? Again, this is why my answer is always just go ahead and lock if it's the right time. Don't get cute with it and move on, and so on. I would just say, kind of as a last point, as pipeline hedgers, of course, we're not taking a risk position here. We're always reactive. But of course, a holistic view of the overall economy is very important too. So anyway, that's a long way of saying it's a challenge, but I also do expect kind of non-traditional sources to maybe take on elevated importance in the future as well.
Yeah, I would agree with that. So Ira, when you talk about non-traditional sources, it seems like what I've seen out there are companies and individuals, capital markets relying on things that were sure things, like the information provided, the service provided by Poly, for example. They tend to grasp those things, or maybe things that aren't so tried and true, like as James just mentioned, kind of this informal alternative source of news. And there are, ADP, for example, or business optimism, or whatever it might be, some measure of inflation or the job market or the housing market that, Case Shiller, or whatever it might be, that gives some indications in terms of which way the economy is going. I know that you are very good at following the news, and you're very good at hearing what the Federal Reserve governors are out there saying. Uh, do you have any sense if they've changed their tone as the shutdown progressed? I mean, 40 days, however many days, 35, 40 days of shutdown can't bolster the economy. So have you sensed a change in their tone in terms of the economic direction that the United States is going?
Yeah, I think when we look at the Fed, obviously the Fed is looking at the data, they're looking at the major data reports, but without data reports, what can they look at this point? I've seen a lot of arguments, supporting that the Fed should not cut this next December meeting. We saw the probabilities of a cut, you know, uh, you know, go down over the last few weeks. So we've seen similar sort of conversation between Fed members, maybe saying, December's not necessarily a given, as opposed to the last couple of months where we all knew they were going to cut 25 basis points. But without any data to support a cut, why should they cut? And I guess that's one of the arguments sort of going on right now. We've been lucky in during this shutdown that generally, overall, it's been a pretty low volatile market, right? Rates have remained steady. We've been in the same range over the last 30, 40 days. So without anything coming out to sort of justify the decision one way or the other, what do we really go by? What is a 25 basis point cut going to truly accomplish this next meeting, except anger, let some angry tweets come out. you know but just to quickly, the point about the alternate data points, we always had ADP come out, but everyone sort of leaned towards non-farm payrolls, and it was mentioned about the revisions to the non-farm payrolls, not to get go down that road, but at the end of the day, has ADP sort of had the right numbers the whole time, right? And that's when you start to look to these alternate reports, such as one that came out last week, maybe not painting as rosy of a picture in the jobs report as a government report would show. We see all the headlines. You read these headlines, these big companies with layoffs, and then we get a jobs number that comes in either at or above expectations, and you're sort of like, where are these headlines coming from that it doesn't match the data? So all that to say, still remains to be seen what the Fed's going to do. I still think they're going to cut a quarter, but I don't think it's going to be as certain. I'm more interested in their projections. So we do have the summary of economic projections coming out on this December meeting. So it will be interesting to see where they project, the federal funds rate over the next 12 months, because I think that's going to be more of an impact than the actual decision itself, unless it's sort of a surprise pause on December 10th.
Yeah, that a pause would be a bit of a surprise or a big surprise. As I understand it, and I'm not privy to these discussions, obviously, but each Federal Reserve district has sources of news that feed up to the district president,
Mhm.
and much of it is not a result of the federal government's research. A lot of it is, different kinds of news sources that different Fed areas use to determine the health of their district, right? And so I think that they've been relying on that more uh, as we don't get the federal data out. I don't, Rob Kessel, you mentioned, you don't know exactly the flow of information that we're going to get. I don't know it either, but somebody at some point will announce a schedule. I have to imagine that that data is sitting there in some data bank somewhere, and it won't be that hard to crunch. But then again, I don't know. It's not like we're going to get, deluged with all this pent up information, next Wednesday or something. It'll dribble out, and I think the market will react accordingly. And I would be I just get the sense I don't like using a crystal ball either or pretending I even have one, but I have the sense that the job market is slow. Uh, Inflation is what it is. I mean, President Trump said that Thanksgiving dinner this Thanksgiving costs less than last year's Thanksgiving dinner, so that's good, right, for the average family. And but I'll tell you, when I go out to eat at Denny's or Olive Gardens or a Plebee's, as my son Robbie calls Applebee's, a Plebee's. Um, I'm stunned at how much a restaurant meal costs these days. It's really expensive, and I don't know how a family of four, you know, making whatever families of four make, can really afford to eat out too much. And even when I go to the store, my Captain Crunch box size seems to be diminishing. The price keeps going up. So, I don't know what's going on out there, but I can't imagine inflation is that much under control. So yeah, you got the labor market versus the inflation question. Um, we have a minute or two left. Rob, James, Ira, any closing thoughts on if you were an originator on this call? Any last bits of advice you would give them in terms of uh, what you're seeing out there?
Maybe I'll just say the theme of a lot of, I think, what you just said, Rob, is uncertainty, and there's a lot of moving parts out there. And I think the thing that the market really gravitated to in last press conference following the FOMC meeting was when Chair Powell said something to the effect of, he asked kind of a rhetorical question. He said, what do you do when you're driving in the fog? You slow down, right? And that seemed to be the biggest thing that the market picked up on. We have a government shutdown. We have questions about when we're going to get the next data. Is it going to be as reliable as it is? We have questions about what the labor market looks like. We have questions about what the inflation picture is, and so on. That's all just to say it's a lot of uncertainty right now. And certainly my input would be that that's what I would be communicating to borrowers, is that there's a lot of moving parts for now. I think we've used the phrase crystal ball about 6 times in the last 10 minutes, and none of us have it, right? So it's just a conversation of understanding what's going on right now, understanding the world. It doesn't make it easy, right? But I think just explaining that this is a pretty unique time, and hopefully having that conversation with borrowers accordingly.
I think you summed up everything, James. So thank you. I'm not even going to let Rob or Ira interject. So, for those of you still with us, thank you very much for tuning in. Thank you very much for Polly for sponsoring this, and we'll do it again in early December. December. I mean, 2025 is nearing the end already. Didn't it just start? I don't know. I don't know. Sometimes the days are slow, but the years speed by. Anyway, all right. On that philosophical statement, thanks, guys, and we'll see you in a month.